Welcome back. You're watching Closing Bell. Farmer issues have been a key talking point in the build-up to the 2019 general elections, with both the BJP and the opposition trying their best to woo the farmers. Earlier today, Lata caught up with Abhijit Banerjee, professor of economics at the Massachusetts Institute of Technology, to get his sense on what are the best ways, perhaps, to deal with rural issues. Lata asked him for his opinion on how the government can help farmers in times of distress.
What we've done with the price support is we've kind of gone the opposite direction. I think in the sense that we've banned exports. We have imported when we had large surpluses. So we've moved the terms of trade against agriculture quite kind of with a clear and I think rather committed hand. So I think that if you look at what happened to the farmers, if we just let world market prices be the prices that rule, they would have not, the distress wouldn't have been there, or most of it wouldn't have been there. I think so. I do feel, given that we have some obligation to do something about them. And the question is a bit, what's the fairest thing to do? The problem, so I think the advantage of loan waivers is that we know how to do it. At some level, they're straightforward to implement. The disadvantage is also more or less the same thing, which is we know how to do it because we know who the people with loans are. But I do think that there is a real issue there of, how much can we afford if it's universal? And I think the government's other initiative was trying to deal with that. That was the Fasal Bima Yojana.
Yes.
So one thing the government could have done instead of any of these is just implemented that better. That was very badly implemented. It hasn't really reached people. And part of the reason was that it was designed in a way that was completely ham-handed, and that particular opportunity was lost. So another thing the government could have done, aside from these three options, is to just implement that better, to make sure that people get stable prices and they don't get punished in droughts. And that already would have solved a fair amount of that problem. I think if we didn't create the price distortions we've been creating, that would have helped. So I don't think these are the only options.
Wear your economist hat and explain to us the macro problems that this will create. I mean, whether it is a universal income or loan waivers, both create macro problems. So let me first start with the fiscal deficit. Will not that be counterproductive if we were to overspend? And, inflation or higher interest rates would kill what we get by way of income.
I think the only way to really pay for something like a universal basic income would be right now to start thinking of what schemes to cut. I mean, in the medium run, I think we are undertaxed. We really, despite whatever the financial sector will tell you, we have year after year, we have kind of let the slab drift up so that we've never really had more than 2.5% of the population in the tax net. And then there is all kinds of other, people don't pay the taxes, etc. But I think we have done very little on sort of generating a good, effective, progressive, direct taxation. We're sort of now saying GST will solve our problems. GST is an extremely regressive tax. It has no progressivity whatsoever.
We've tried by making it 5 and 12 and 18.
But it's still difficult to do because if you give up lots of revenue or you basically collect it from everybody, and we're not doing very much of anything else. We're moving towards one slab, and I think that's probably a good idea, but then we haven't really put any effort into creating, the usual mechanism for expanding the tax base is by keeping the bottom slab fixed, and as the people get richer, they pay more taxes. That's what happened in China. China was below us. They had 1.5% of GDP in direct taxes, and now they have 8 or something. And if we went up to 8, we would have money to pay for lots of things. So I do think that the first order, we shouldn't miss that big picture story, which is that we need more taxes.
We need more taxes, not something that usually goes down well with the masses. Let's now move on to another exclusive. E-commerce giant Amazon has been hit by a data breach issue in India. We learned that the company faced a technical glitch which led to a data breach of sellers' business records on the platform. Our new correspondent, someone who's recently joined us, and she's based out of Bengaluru, Mugdha Variyar, is standing by with all the details. Mugdha, tell us more.
Yes, this problem came to light on Tuesday morning when several sellers logged onto Amazon's platform to download their monthly sales reports. These monthly sales reports, also known as merchant tax reports, are usually downloaded by these sellers between the 8th and the 10th of every month in order to file their GST returns. Now, some of the sellers I spoke to said that the reports they downloaded this time carried incorrect data as well as data of other merchants on the platform. So this is what has raised concern among sellers that their own business data could have been exposed to other merchants as well. Now, these merchant tax reports mainly carry sensitive business data of these vendors on the platform, including their orders processed, the sale volumes across categories, as well as the inventory. The scale of the data breach is not clear, but Amazon has over 4 lakh sellers on its platform across the country. When contacted, Amazon India said that the problem had been identified on Tuesday and that it was a technical issue which had been rectified within a few hours. And Amazon now says that the sellers now have access to the correct merchant tax reports.
Come back. There's one thing that markets are eyeing right now, and that really is the US-China talks that have concluded, but it is the release of the conclusion or what really was discussed. The outcome of this meeting, that is yet to be released, and that is what we are awaiting at this point in time. And ahead of that, you have seen markets actually do quite well for themselves, whether it was the Asian equity markets, which have been positive through the day today. The US dollar, of course, has been on a softer footing, but most of the high-risk currencies, the commodity currencies, have done quite well. So have the commodities themselves. If you look at the crude oil prices, we are trading nearly 2% on the higher side. The metal prices have continued to rise as well. And all the safe havens, including the Japanese yen, the gold and silver, actually have seen a decline. So markets clearly anticipating a positive in sense of the US-China talks that were extended for a third unscheduled day as well. But Alvin Tan, Forex strategist at Society General, now joins us to get a sense on how really the markets are looking at this meeting concluding. Alvin, hi. Thank you so much for joining us. It clearly has been the big talking point really for the last couple of days. And right now, as we await the release, what is your sense? We are, expecting a positive outcome clearly. Do you expect a knee-jerk reaction once we hear those statements come out?
Hi, I think it's fair to say that the optimism about the trade talks is largely in the price already. We have, as you mentioned, seen quite a big rally in risk assets since the start of the year, and of course we've had some positive tweets from President Trump on the state of U.S.-China trade negotiations. So I think the market is expecting a positive outcome already. That said, it's important to note that this is only the start of the talk. So it's very doubtful that we have a comprehensive agreement at this stage. In fact, further talks at the more senior level are already expected later this month. So I do not expect a comprehensive agreement to be reached yet.
Alvin, also, what is your sense on the US dollar index? Because most banks, brokerages do believe that we will not see a repeat of the strength in dollar as we saw in 2018. I mean, whatever we have seen at the beginning of 2019 does go right with that. But going forward, there is just so much uncertainty, so many events, data flows expected. What is your own sense on the dollar index?
Okay, on a broad note, we do expect the U.S. dollar to weaken against the major currencies, principally the yen and the euro, over the course of this year. However, it's unlikely to be a very sharp fall in the dollar. We think that the retreat in the dollar is likely to be more gradual and fitful. And I think in the near term, we are concerned by the fact that the market has priced in no Fed hikes this year. In fact, there's even a slight market pricing of a potential for a Fed cut by year-end, so we think the market has really gone overboard on that front. I think Fed Chairman Powell's speech tomorrow is going to be very important in this for trying to set the market expectations about what the Fed's going to do going forward. So definitely in the short term, we are quite wary about the market's negativity about the dollar. We do think that in the short term it's probably a bit overdone.
Alvin, also, what is your sense on the Asian currencies now? Because today, even as the US dollar is softer and there is a bit of a risk appetite on, and we've seen many of the emerging market currencies actually trade on the positive side, the Indian rupee clearly has, shrugged that off. We are already down nearly 0.9% in this year as far as the Indian rupee goes. And this is after that dismal 9% decline of a performance that we saw in the previous year as well. What is your own take?
Yes, for the Asian currencies, what's quite important for the outlook, quite apart from the broad dollar direction, is what happens to the US dollar renminbi exchange rate. I think for the Asian currencies, dollar CNY being anchored under 7 has really helped to anchor the entire Asian complex. We do expect the dollar CNY will be kept under 7 during the duration of these negotiations between the U.S. and China. However, in the next several months towards year-end, we do think that dollar CNY will rise above 7 because the Chinese economy is slowing down. I mean, we've just seen these car sales numbers from China, and they're the first decline in many, many years. So this Chinese slowdown, and we can see that the Chinese government is increasing stimulus measures, and a stronger currency is just inconsistent with the stimulus measures to help the economy. So we think that a dollar CNY will start to rise above 7 several months from now, and that will also pull the Asian currency complex with it. Now, the Indian rupee is an interesting case because it's been the Indian rupee with the Turkish lira has been among the worst performers in the EM complex since Christmas, and that is because crude oil prices have rallied about 20% since Christmas. So you can see that crude oil is a very important factor in the outlook for the Indian rupee. We do think that there is further upside to crude oil prices, and as such, we are not particularly positive the Indian rupee in coming months.
All right, Alvin, we'll let you go at that. So that's a view really coming in from Society General. US dollar continued to be softer, but the Indian rupee with that also expected to be soft with what the crude oil prices, of course, We'll come back, and it is the crude oil prices which are making all the noises, up nearly 2% right now as well. And we have seen the $60 mark come back for the Brent prices. Preetham Kumar Patnaik from Reliance Commodities now joins us. Preetham, hi. What a start of Jan 2019 it has been. What is your sense with the kind of gains that we are seeing in this space?
I just hope all the broader markets have a great new year like crude oil has had. Okay. So the last few weeks have been great for oil. You know, it hasn't had the daily increases on prices like this is not seen since summer of 2017. Actually, the prices have advanced almost about 12% in the last 7 trading sessions, which is like erased almost about 50% of the last year's losses. Okay, this is primarily because of the fact that there is a growing amount of optimism about the China-US trade deal happening. And that's kind of taken up the risk averseness in the market and given a sense of optimism in the market. Further, everybody has also got a lot more confidence saying that the OPEC and the allied nations will do whatever it takes to ensure that the demand, there's no situation of oversupply in the market, and these factors have kind of pulled the prices and been supportive for crude oil. What one needs to also observe the inventory. The inventory data continues to be, while there was a shortfall of almost 6 million barrels last time, AIA report suggests. But there's another independent report which kind of suggests that there's a lot of build-up on gasoline in US. So it's kind of a little mixed. I think also that the crude oil markets were too much into the oversold territory, and there was a bounce back which was expected. And it was aided with the positive news which is developing all across. So that kind of pulled the prices higher. So our view is very clear that while this rally is there, one has to be a little skeptical because the rally has also been fairly significant. So we would have a house view of saying we would wait for it to correct a little before we enter the market on the long side. So our call is to buy crude around 35.20 and 35.10 levels with a stop loss of 34.50 and a target of 37.40.
All right, so that's the view coming in for the crude oil prices. Even with those 17% gains that we have seen from December lows, there is further upside coming in the space, is the view coming in from Preetham Kumar Patnaik. But with that, completely out of time on this edition of Closing Bell. Thank you for watching.